So welcome to our now 25-minute, 23-minute quick workshop on the keys to home ownership. So yeah, as I said, my name's Dante Fyfe. I'm a financial advisor based in Christchurch, Ōtautahi, Christchurch. Let's see if I can change the slide here. Yes, so yeah, we're gonna have a quick intro, and then I'll just go through basically the process of getting into your first home, and then some of those costs involved. So there's normally some hidden costs that people aren't aware of, and normally you have to pay cash up front before you even get into the house. So just going over those sort of costs. If we have time, I can go over the costs that might be involved in actually maintaining that mortgage over time, or even some of those other costs like low equity fees and things like that. And then we'll go through deposit, serviceability. So those are the two main parts of getting into your first home. And then hopefully we'll have time for a couple of questions, and then we'll close off. Cool bananas. So this is me. Who am I? Yeah. So half New Zealand Samoan, half New Zealand European. My parents actually met in the army many, many years ago. Mum is New Zealand Samoan, grew up, born and raised in Māngere, Auckland. And in fact, I might as well tell a little bit of that story. So my grandparents immigrated from Samoa in 1957, so long before the Longi era. And 1957, flew into Whenuapai base. 3 years later, they bought that home in Māngere. So in 1960, they bought their first home. And I've always really wanted to know how they managed to buy their first home. 3 years, new immigrants, what those conditions were like, housing market, the New Zealand economy and things like that to allow that to happen. But they bought their first home. Fast forward to today, and it's worth, I don't know, 1.3 million. I think in Māngere is pretty standard, 1 to 1.3 mil. So that sort of decision making back then, is going to benefit their kids and future generations, I guess. So interestingly enough, I'd love to know how that worked out. But yeah, that's half my side, and then the other half is New Zealand European. My dad. His lineage goes back to Scotland, hence my last name Fyfe. And then there's a pinch of Tongan and there's a pinch of Ngāpuhi in there as well. Sports, yeah, I play a bit of sport. They sort of traditionally contradict each other, but I play netball and a bit of rugby at the moment, and I used to play a lot of rugby league growing up. And then in the community space, I do quite a bit in the Pacific community down in Christchurch. And then also some volunteering on boards and sort of committees and things like that. I've been 6+ years as a financial advisor, and 3 years out on my own, 3.5 years out on my own. So yeah, that's a little bit about me. This is sort of my business. It's just me, work for myself, but we have to form a company when you work for yourself in my industry. And this is what I've decided to call myself, Moana Mortgages Plus. Do a bit of Kiwisaver investments, advice, mortgages, and a bit of personal insurance. My main sort of client base is first-time buyers. So let's get into the nuts and bolts. So yeah, process and costs. I mean, buying your first home is pretty exciting, but it's good to know what to expect along that journey of getting into your first home. And I think the biggest part of it is putting together all the documentation. So whether or not you go to see a mortgage advisor or financial advisor that does mortgages, or a bank directly, you're going to need to put together quite a hefty amount of documentation. And what we're talking about there is, the last 3 months worth of your bank statements, all of your account statements. So bank statements, loan statements, credit cards, store cards, farmers cards, things like that. All those sort of account statements, you're going to need the last 3 months. Photo IDs, So proof of address, Kiwisaver statements, that's another one. Deposit, evidence of your deposit if you've got it tied up with investments, gifting certificates, and evidence of income. So normally it's your last 3 pay slips. It might be your contract if you've just signed it. It's got to be sort of open term, but there's a whole lot of documentation basically that you need to put together for the bank or for the advisor, and then you're looking towards getting a pre-approval. So that's that journey, is put together the documentation, and then you're trying to seek a pre-approval. Or sometimes if you've already signed the sale and purchase agreement, which I hope you haven't, but you'll normally chuck that in there with all that documentation, and you're basically trying to go straight to towards settlement rather than a pre-approval. But hopefully, if you're going through the process with less stress, then you're going for a pre-approval. Then you can go house hunting with a bit more confidence. When you go to make an offer, there's a letter from the bank or a couple of banks where they are willing to finance it. There's still going to be some conditions there that get finalized in between your offer being accepted and settlement, but for the most part, you can go house hunting and offer on a house with a bit of confidence. So yeah, you make an offer on a property that you like. You've gone to the open home a couple of times and all that sort of thing, and then you make an offer through the real estate agent. But what I would say is, while you go house hunting, because the real estate agents will kind of push you to make offers if you are making noises like you're keen. Make sure before you go house hunting or during that time, make sure you talk to a lawyer. A lawyer will just make sure that when you go to make an offer, that you're going through that offer process correctly. So yeah, I'd definitely engage with a lawyer around that house hunting stage, and just make sure that you don't make an offer without their guidance. Okay, so yeah, you'll go through the real estate agent, you'll make an offer, and then if it gets accepted, cool, awesome, that's great. You'll sign a sale and purchase agreement through the real estate agent. Both their lawyer and your lawyer will sign off on that sale and purchase agreement, and then you'll work towards making the conditional approval. And the conditions within that sale and purchase agreement, there's a period, it's normally sort of 10 to 15 days. You'll have a bit of time to tick those boxes. Those are things like building reports, valuation report, those sort of things get ticked off during that 10 to 15 days. The sale and purchase agreement will go unconditional, and then it's sort of like roughly, it depends on the two parties, but you work towards a settlement date, and that could be roughly a month, 4 weeks, and you'll have a settlement date. Settlement date's when you're kind of signing off on the loan agreement with your bank. The bank will pay the seller of the property, the vendor, and you'll get the keys. So the settlement's when you're basically getting the keys and they're getting paid. And then there's just that process. It's kind of a reminder point that when you've got your mortgage in place and you start paying your mortgage and you've fixed for a year or whatever it is, that you are reviewing the structuring of your mortgage. There is a maintenance to your mortgage as well as your new home. Cool. Costs. So yeah, I mean, for sure there's loan fees, and the banks, that's that interest rate. They're going to charge you fees in and amongst that, but in terms of our process, if you've got, at the moment it's lower than 20%, most of the banks will look to put a sort of low equity margin, low equity fee on top of your interest rate. So it could be like 1% or something like that if you've got less than 20% deposit, at the moment as it stands right now. So that's just something to be aware of, especially in terms of your calculating out your mortgage repayments. That's the biggest thing, is there's some of those fees that can accrue or be put into it, and you might not be aware of it up front. There's also a builder's report fee, so it can range. It can range, but I normally say budget around $1,000 just to be safe. You're going to have to pay for that up front. That's got to be cash in your back pocket, the builder's report fee. That's going to come in between the signing of the sale and purchase agreement and then the sale and purchase agreement going unconditional. What's called unconditional is that time, that 10 to 15 day period, you've organized a building report and that gets signed off by you and your lawyer and the bank. But that's a fee. I normally say budget for around $1,000, depends on which builder you're going to, I guess. But the other fee there is valuation report. That's something that normally gets brought up. So generally speaking, that can be around $700. If it's an urgent, if the valuation report is needed urgently, you might pay a little bit extra, $100 to $200. So again, I say to budget roughly $1,000 just to be safe. And then yes, your deposit, that's another cost involved with the process. But the lawyer's costs, that can, depending on the depending on the complexity of the transaction and your interaction with the lawyer, because every time you call them, every time you email, that's going to cost you money. But in saying that, to balance that out, you've got to be safe. You've got to feel comfortable that this process is going right. I'm just very aware of the time. We've got like 10 minutes left, so I'm going to go to the next slide. Deposit. So there's two parts to getting a mortgage. Most of us in New Zealand, most Kiwis, we get caught up with the deposit. And that makes sense because that's kind of the biggest hurdle. It's going to make up the biggest piece of the puzzle in terms of saving and, income over expenses and that. But the other half of the battle is what's called serviceability that we'll get to. But to start with, let's look at deposit. So obviously in New Zealand, we're quite lucky. Sir Michael Cullen brought in this, I think he's called the father of Kiwisaver. He brought in Kiwisaver, and that, in my experience, makes up the vast majority of most first home buyers' deposits. It makes sense. When that's automatically coming out of your income over 5 to 10 years, whatever the period is, that's obviously going to make up a bit of money. So Kiwisaver, it is important and it forms the majority of your deposit. There's technically 5 different structures for your funds. Most of us know the 3 middle ones: conservative, balanced, and growth. But just be aware of those other types: defensive and aggressive. If you're looking at sort of 20, 30 years of leaving your Kiwisaver, so you've bought your first home, you leave $1,000 in your Kiwisaver, look towards the growth and aggressive. You're not going to be able to touch it for the next 20 to 30 years, for most first home buyers. But on the other end of the scale, when you are looking to buy your first home and you're sort of 6 months to a year out, you want to start moving most of your funds into a defensive fund. Because even conservative, normally they have about 20% in growth assets. So you want to actually move into defensive, where it's more like 2 to 5% in growth assets, and you're actually trying to protect as much of your deposit as you can. So just look for those defensive funds that are out there as you move sort of that 6 to 12 month window out of withdrawing for your first home. These are those contribution rates, 3, 4, 6, 8, or 10%. When I bought my first home, I was 26. I'm 35 now. When I was 26, I had gone into Kiwisaver a few years before that, but I'd only gone the minimum, which at the time I think was 2%. My partner at the time, on the other hand, she'd gone the maximum, which I think at that time was 7 or 8%, something like that. When it came to us buying our first home together, she had way more Kiwisaver than me. I had more cash savings to put in, but she had way more Kiwisaver. So I do put an emphasis, if you are on that journey of, you're a few years out, then look to try to maximize your contribution rate. and also ensure that you're putting in that 3%, and if you're employed, that your employer's putting in 3%. But all of these things within that Kiwisaver, the money you're putting in, your employer's contribution of 3%, and then the government's contribution, that all will make a big contribution towards your deposit. That'll form a big part of your deposit. And that government contribution, as long as you're putting in roughly, works out about $1,000.43 a year, the government's putting in roughly half of that. It's a 50% return. So it works out to be about $21 a week. As long as you're putting in $21 a week into your Kiwisaver, the government, that works out to about $1,000.43. The government will put in roughly $521 kind of thing, 23, 24, 21. But it's a 50% return. It's a no-brainer. But I have met with people that do not believe in Kiwisaver for whatever reason. Yeah. Again, there's other options that can go into your deposit. Gifting, I mentioned that earlier. Savings, obviously, outside of Kiwisaver. Equity. So that's one that's coming up more and more these days. People are trying to think outside the box. Parents are willing to use equity, and grandparents now are willing to use their current homes, the equity that they've built. Some of them are freehold, or they've got a minimum mortgage. They're looking to use that equity that they own in their home to help the child or grandchild into their first home. And that's possible. So talk to your bank or your mortgage advisor about that as an option, if that is available. First home grant, yes, up to $5,000 for each person, each applicant for existing properties, or up to $10,000 for new builds. And when I say up to, you have to have been putting into your Kiwisaver for 3 years. And then it's sort of, once you qualify at that level, it's basically between 3 and 5,000. So up to 5 years. So it's $1,000 a year past that 3-year mark. So some people, I'm talking to at the moment, they're like, oh, I might wait 3 years, because they're first, like, these were a couple of new immigrants from Argentina. And they said, oh, look, well, we're going to wait 3 years and build up, and then they're going to have, $3,000 each, which will cover pretty much a good chunk of those upfront costs, builder's report, valuation report, and a touch of the lawyer's fees. The other half of the battle, I'm just aware of time, the other half of the battle, and it's the other part that Kiwis, we either aren't aware of or we forget, is yes, deposit, but the banks are really looking at your serviceability. And what does that mean? What we're talking about there is your income minus your expenses. What is left over? The banks are looking for a surplus. Now, they calculate things on a monthly basis, but it doesn't matter. Even if you're working off a weekly budget or a fortnightly budget, they're just going to times it by 52 or 26, divide by 12. Okay, but they work on what's called a monthly surplus. That's what they're looking for. At the end of the day, it just needs to be a surplus. When I'm talking about income over minus expenses, it's your expenses where you're taking away your current rent and you're putting in the new mortgage repayments. So if you're trying to calculate it yourself, yeah, take away rent, put in the new mortgage repayments. But another thing is that I've noticed is us as Kiwis, we'll go into a bank, probably our bank, the one that we're doing our everyday banking with. We'll go onto their website and we'll use the mortgage repayment calculator. The tricky thing with those repayment calculators is that the interest rate that they're using for that mortgage repayment, you might insert it yourself, or there might be a drop box or something like that. Make sure you add, it's at the moment, it's kind of like you need to add 1 to 2% onto whatever's been advertised. Because at the moment, most, pretty much all mortgage advisors and the banks, whatever you're seeing advertised, we're actually testing at a much higher rate. We're testing your mortgage application at a much higher rate. So at the moment, we're testing your rates at sort of 8.5 to 8.7%. It's not been tested at 6.7 or whatever's been advertised right now. So just be aware of that when you're doing the calculation of, I'm taking out the rent and I'm putting in my new mortgage repayment calculation. It's just something to be aware of. And then also the term in there, but I won't go into that. The other thing with expenses is that you want to add in house insurance, house maintenance costs, that sort of thing. You're building your expenses as being, this is what I'm going to be paying when I get into the mortgage, when I get into the first home. Okay, so it's just, that's what the banks are looking for. They're looking for that surplus after that new scenario of income minus your new expenses. Okay, try to think outside the box. These days we are having to think outside the box in terms of borders and things like that, coming in with siblings, friends, cousins, whatever, family. In terms of serviceability, yes, they can help in terms of deposit, but also in terms of serviceability. Loan structuring. So a couple of things that I want to mention. This is kind of at the point where I just want to plant a couple of seeds, is having a look at ways to pay your mortgage off faster. And one of the big ones at the moment that people are talking more and more about are offsetting accounts. Now, not all the banks do these offsetting accounts, but I just want to plant this seed. Have a look into offsetting accounts as you go into this journey towards your first home. Because when you go to structure your mortgage towards the settlement time, you want to ask those sort of questions. How do I structure my mortgage right now to pay it off as fast as I can? Generally speaking, most first home buyers, when we go to structure the mortgage, it is about just, I want to pay the minimum. What is the lowest interest rate, and let's just fix that for whatever the term is.